When traders talk about options, they often mention volatility. But in real markets, volatility is not just a single number. It changes depending on the strike price and the time to expiration. To capture all this information, traders use something called a volatility surface. So what exactly is a volatility surface? It's a three-dimensional map that shows the implied volatility for options across different strike prices and different maturities. Imagine one axis for strike, one axis for time to expiry, and the height of the surface shows the implied volatility. Why do we need this? Because in the real world, option prices don't follow the simple assumptions of models like Black-Scholes. Black-Scholes assumes volatility is constant, but markets tell us otherwise. When you look at implied volatility for different strikes, you often see a curve, not a flat line. For example, if you plot implied volatility against strike price for a single maturity, you might see a smile where out-of-the-money puts and calls have higher implied volume than at-the-money options. This is called the volatility smile. In equity markets, it's often a skew, where downside puts trade with higher implied volume than upside calls. That reflects traders' fear of market crashes. They're willing to pay more for downside protection. If you look at volatility across different maturities, you'll see the term structure of volatility. Sometimes short-term options have higher implied volume because of upcoming events, like earnings announcements. Other times, longer-term options trade at higher volume because of uncertainty in the future. By combining strike and maturity together, you get the full volatility surface. Traders use this surface every day. It helps them price new options, hedge their portfolios, and spot opportunities when certain strikes or maturities look mispriced compared to the rest of the surface. To sum it up, the volatility surface shows implied volatility across strikes and expirations. Smiles and skews reveal how the market really prices risk. Term structure shows how volatility changes with time. And the surface as a whole is the language traders use, instead of relying on a single volatility number. If you found this video helpful, make sure to hit like and subscribe to the channel for more clear and simple explanations of trading concepts.